Hello and welcome to How to Manage Risk, the channel for the governance professional, aspiring professional and the risk curious. If you enjoy the content, please like, comment, subscribe and share for more risk interviews as soon as they come out. If there's anything you're particularly interested in hearing about, please let us know in the comments. We are also coming to Spotify. Well, hello and welcome to the Jester's Guide to Risk Management for the governance professional, aspiring professional and the risk curious. And today I'm delighted to welcome someone who I think is a bit of a legend in the risk management profession, Dr. Colin Lawrence. Welcome, Colin, and thanks for joining us.
Thanks for inviting me, Emma. It's a pleasure and a privilege to be with you.
Thank you. So Colin is known as one of the world's foremost experts in risk management. Now an active non-executive director, not only has Colin worked for a number of the largest financial organizations, but was also director of the risk specialist supervision for the Financial Services Authority, and also he was also strategic risk advisor for the Prudential Regulation Authority, responsible for developing the U.K.'s financial services sector stress testing framework and technology. Colin previously served as chairman and vice chairman of PRMIA, the global board, and he is also honorary visiting professor in risk management and regulation at UCL. So we jesters are in good hands today. And Colin's come to talk to us today about financial system failure, my goodness, the system effects of such failure, and if we have time today, why financial institutions are just so important for the mitigation of climate change. So thank you, Colin. Shall I kick off with the first question, sir?
Go ahead. Yeah.
Okay. So number one, is it usual for financial systems to fail? And why do we continually see a repetition of this?
Yeah, when you look at all these failures that have occurred, going all the way back to the 1920s, to the big crash in 1929, to our own crash in 2008, and all these situations where there's a crisis, such as the S&L crisis, and then the Sam Bankman, the FTX crisis, the crypto crisis, they all do share common themes. However, there's also a lot of uncertainty in them. And I told you over the phone, it was my view that I wonder whether our profession should be risk management as opposed to being the right thing, which is uncertainty management. The key difference is in risk, you really know what the outcomes are and you know what the probabilities are likely to be. In uncertainty management, you don't know when it will happen and you don't even know what the probabilities are. So we've built our risk management culture around the latter rather than the former. And the great Austrian economists, they basically believed the world was uncertain and we don't know. However, having said that, I think the two are linked together. We might not know all the outcomes, and that's why we created stress testing actually in 2008. The US did CCAR, we did our own at the Bank of England, and the Europeans did their own. And really it was around stress testing, which is another way of saying we don't know what the probabilities are, but if this event happened and say GDP collapsed by 10%, what would be the ramifications on the banking system, and what would be the policies to follow?
No, that's really interesting. And was there anything that you would like to say about two particular banks? Are we able to do that on this podcast? Silicon Valley and Signature?
Yeah, so it's quite interesting in those banks. Now, the previous crisis we had, particularly of Californian banks, was the S&L, the savings and loan crisis, which actually, when you look at it, was one of the biggest crises, yet it still happened. Slightly different reasons to Signature and Silicon Valley. Now, in this case, as in S&L, it had to do with liability management of the bank. In the S&L crisis, it was that Paul Volcker had raised interest rates to curb inflation in 1979. And suddenly there was this gap between funding costs of these savings and loans institution and where they would invest those funds. And that gap became staggering, and essentially they were insolvent immediately. Now, SVB and Signature is different in that it's more around, not around interest rates, it's more around liability management, because what happened, they were like clubs for all the people involved in the tech sector. And suddenly people were worried about those banks, particularly after FTX, I'll talk about in a moment, which was the crypto crisis. They started withdrawing their money, and there was a rapid outflow of funds. And these are big banks. One of them is in the top 10, the other in the top 20 in terms of outflow. So it's just trillions of dollars being pulled out. So it reminded me, in a sense, though slightly different, the one's an asset liability, this is more of a liquidity sort of crisis. But this time the Federal Reserve acted immediately. It pumped in the money, and the banks went away, rather than allowing it to fester and spread. So clear and cogent policies by the Federal Reserve, by the central banker, is absolutely critical to put the fires out. But then you've got to go back and say, well, how did this happen? I mean, there is a new regulation around interest rate management of the balance sheet. And I'm wondering, was there any serious governance and risk management? Well, I don't think there was, because they would have noticed that concentrated depositors, they were all of one sort. They were corporates or SMEs or tech players. And one event in the tech sector sent all their deposits out. And that's what led to the crisis. And it could have spread, as, these banks banked with other banks, and then they pull their deposits out there, or their reserves, and from correspondent banks. And that's why it could have been another systemic failure. The risk management of this would be, well, we've now seen it. Look at the concentration of depositors. Are they just ordinary retail depositors who just keep their money in there no matter what? Those are the sort of HPC depositors. No matter how badly they treat you, the money stays there. It's sort of safe, and you don't have to worry. And moms and pops, etc., keep their money. But now we're in a world where you've got these savvy tech players, and they were the bulk of deposits in there. So you got to look at that. So, and that's what happened. They pulled their money.
So issues in the portfolio, effectively.
In their liability.
Yeah. Yes, exactly.
And that's interesting, because we've now moved on since the crash of 1929. The S&L crisis was the 1970s. We've had so many crises. And then regulation has been brought to actually look at that in detail. You are supposed to know when your customers could withdraw money or deposit money, and you have to analyze that. So that's a new theme in risk management. It's called IRBB, interest rate risk of the banking book, and obviously it wasn't done. Also, politics entered over here, because when the Trump administration came in, they sort of undermined, the core of prudential regulations on smaller banks, relatively smaller banks. They said, well, you don't have to do the stress testing. Don't worry about it. Very, very popular. And this is another theme right throughout. We have libertarians that believe there should be no intervention. Why bother them? But quite clearly, we know that you can create systemic risk. It's a public bad in the system and can bring the whole system down. And so that's what we have to watch. What are the systemic impacts from something like this? A bunch of savvy tech guys decide to pull their money out, worried that the bank will fail.
Yeah. And on such note, I know that you wanted to mention FTX, Colin, and talk a little bit about that and the crypto crisis. Could you just make a comment on that, if that's all right?
Yes. So on crypto, my own view has always been, I'm very hesitant to actually believe in the efficacy of this so-called, call it private money, if you will, crypto, because, in learning the theory of money, go right back to the basics. Why do we have money? And we talk about, three components. One is unit of account, that it's a unit of account. Everyone talks about, I'm going to sell this, it costs $20,000 or sterling or whatever it is. We understand what it is. And because it's offered by the ability of the state to tax people. So it's built, with backbone. Of course, there have been issues of inflation, which sort of burns, the value of the deposits we hold in banks. But a unit of account. I don't see a unit of account, okay? I mean, the second point is the medium of exchange. We don't see it facilitating. It could facilitate some bad stuff. For example, because it's private, okay, the whole idea of blockchain was that it would be open to the right authorities, be they the central banks, etc., to oversee what's going on. But that's not what happened. It became almost involved in dark clouds. So you've got bad money going around. We've had this before multiple times on registered and unregistered notes in the U.K., in the German banking system, for example. So it's a major problem. You got to look at crime. Crime is massive today. Cybercrime is massive. So FTX essentially was just a small failure in governance. SBF, what he had was that Sam Bankman-Fried, what he had was two companies linked to each other. The one was, a research group, really, but all it was a hedge fund, and the other one was an exchange. And then he took the monies from the depositors on the exchange who were putting up collateral and used it to trade. We've seen this. It's just poor governance. If there was a proper risk management committee over here, they would have blocked it. But again, it goes back to the underlying. This is innovation. We've got a crypto exchange, and that's what happened from poor processes in governance and risk management.
Yeah. Could I just ask for you, many years ago when crypto first came out, I remember attending something, and one of the speakers mentioned, if we could barcode these crypto assets, that would potentially help solve the problem if they were more traceable. Do you have a view on that at all?
Yeah, I guess, but you're taking something. You see, I don't buy the premise of it. It's really private money. We've explored private money. We've had it in the banking system. The banking system failed, and that's why the FDIC was created to begin with. Private money. This is private money, and now all you've said is, well, let's make it more transparent. But the whole idea of blockchain was to create transparency. It's sort of like having a single ledger. That's what it's about, that you could see a transaction in place A, B, C, D simultaneously. So it's a great technology. My own view, it's been hyped and pushed. Maybe one day there will be use for it. Maybe it will replace money. But if it does replace money today, it should be backed by the central banks, because otherwise you're back to private banking and private money, which libertarians will tell you is the right thing to do because it keeps government out. But they don't understand history, and they don't understand what the characteristics are of money. Their characteristics are, I can transfer money without anyone tracing it. And then that goes to your question, well, couldn't we register it and put a barcode? But what's it there for? What's its purpose? What's the value added it adds? I will say that there's a great climate novel by Kim Robinson Stanley, a brilliant expert, and in it they use crypto. So the reason he's in science fiction is he says, because then I can ask what would happen if. So I don't have to have any validation. But there's a state where, money is worthless, and the central bankers, one genius woman, an Irish woman in the International Monetary Fund and World Banking Council, she comes up with the idea, why don't we use dare I say it, why don't we use crypto? So actually you investing in carbon coins. And of course, as we get rid of carbon, the value will skyrocket. So we've got to get investors and got to get governments to back. So I found that exceedingly interesting. But everything was done with transparency, with correct governance, and so on.
That's fantastic. And perhaps, Colin, after this, if you wouldn't mind sending me the name of that book, and I can pop it in the description for people if they're keen to find it.
Yeah.
It sounds really interesting.
Called the
And
Ministry of the Future. Sorry, it's called the Ministry of the Future, Kim Stanley Robinson.
Brilliant.
Great read.
Thank you. That's
great read, very challenging. Yeah,
sounds
Barack Obama's books of 2020.
Well, I know that we were planning going on to talk about the systemic effects of these banking failures. So perhaps you could talk a little bit about the systemic effects of when financial systems fail.
Yeah, so firstly, why did these events happen? I gave like about 3 or 4 events. Why did 2008 happen? I always think it begins with some sort of innovation. In the one case, derivatives, okay? It's how you manage derivatives, it's the governance of derivatives, it's the processes, of this governance, and it's failed every single time. So we had mortgage-backed securities, and then we had securitization, and then we had CDOs. So we go through this period, and suddenly the fundamentals are the banks have got rubbish on their balance sheet, and no one wants to fund them. So we're back again to a liquidity crisis. Now, that led to an outflow of usually it's an outflow of depositors. And we see the big bank queues, when we had the failure in the 1920s and the big bank crash, okay? This time, we don't see the queues. Northern Rock, we did see the queues of people wanting to withdraw their money, fearing they'll lose their money. In the 1920s in the US, the same thing, queues of people. But in more modern times, we don't get the queuing. So what do we get? We just get trading of collateral, and the value of the collateral gets lower and lower. Like I could say, Ms. Hawkins Hale, I know you gave me collateral, you gave me your car, your house, but now I want 2 houses and 2 cars.
Yeah.
I mean,
it's frightening.
Everyone's doing that in a chain, and then that leads to, a collapse, a systemic collapse of the system. So the policy, one of the first policies that came out in the 1930s was the FDIC. So Roosevelt signed into law this great law where there would be deposit insurance. And actually, I just worked on a project in Ghana to put in place, believe it or not, Ghana didn't have deposit insurance. And now the World Bank is working on getting all countries having deposit insurance. Really, really interesting.
Fantastic.
So deposit insurance is one of the major ways in which we prevent that the so-called run on the banks. More complex and sophisticated with derivatives, but the principle is when a liquidity crisis takes place, the first thing you do is make sure there is no fire, okay? But someone might light a fuse at some point in some bank, and because the banks are interconnected, it leads to, spiral out of control. So having deposit insurance is a major way, and for emerging markets that don't even have it, it's a great way to solidify the banks and bring in good governance. So first avoid, and then for the government, a systemic failure can lead to a collapse if jobs, housing prices, and so on and so forth. So it's a major thing. So I don't see any reason to thwart that by bringing on private money again, where we had all the banking failures in the 1920s. It doesn't make any sense to me.
So having that private money makes the system more complex, in your opinion, and more likely potentially to fail. Would that be inaccurate?
That would be very accurate. More likely, the more private, the more innovative, okay, the more dangerous it can be for the whole economy. Now, I should say that governments around the world are doing something about it. For example, the concept of sandbox is a great concept, because the sandbox concept is that a regulator, and by the way, it's not only in finance, it's in every sector, that you can go out and launch a product, but it's still under the Q&A, quality assurance of the government, to look at it. And so you do it in small size under certain rules. It is law in Germany. So you can say, this is a sandbox product. We're just trying it out, and you can participate in it. And then it's monitored, etc. And if it's successful, and if the risks aren't as high as thought, then you can do more and more. So sandbox legislation is the new wave of how we deal with technology and innovation, such as blockchain and operating blockchain, and AI will definitely come under sandboxes. People are frightened of it. We know all the good things it can do, whether it's identifying cancer, whether it will be identifying risks in the bank, but it's got to be implemented appropriately. It needs governance, etc. And that's where the regulators say, come and play in my sandpit, and let's see, how it goes. So I think this is a wave of the future to bring regulators, in. But often regulators are like years behind the industry. This has been a major problem in risk management. That's.
And I think that's where perhaps collaboration is. Yeah, and I think perhaps that's where the collaboration is so important between the various industries and things, commercial and ostensibly safe. Fundamentally, please, Colin, why are financial institutions so important for the mitigation of climate change, in your view?
Because the banks, just like we spoke before about SVB being the lender to tech people, now we got to think on behalf of the planet. Let's look at ourselves as being custodians or guardians of the planet. So clearly banks have got a critical role in the allocation of capital. So we should look at it like that. So if we say, like what's come out of COP28, we could say, right, okay, banks, you're going to play a major role. That project can go ahead, that project can't go ahead, and use green properly and not get into the green washing, which is just another way for institutions, I think, cynically to fund more cheaply. So banks play now a key role. And if we look at the regulations, okay, one of the things is that banks have to have a strategy, a climate strategy, and work out, they have to have a business model that what are they doing for green, for the planet, not only the planet, for people too, the health of planet. So it brings in everything from environment to social protection. So for example, we won't lend to people who hire children in emerging markets and so on. So it's all these things. And I know I spoke to you over the phone, but just think of a climate crisis causing an outflow of migrants from area A to B, and firms hiring, more cheaply because these people are desperate and so on. So when you look at the ESG, we're talking about environment, climate, social enterprise, and governance, of course. Governance for us in risk management has always been a major tick box. So the banks then become major allocators of capital to the right project. So it would mean that to lend to a firm, they must prove that the firm are trying to improve their, it's not only CO2, it's everything from biodiversity to methane. And, at COP28, one of the things I was fascinated by was, for the first time, they're going beyond just talking about CO2.
Yes.
Because I think we're getting too vanilla to be focused on one thing, when methane, is absolutely critical, reducing methane, and it's actually listed over there. So and also, it shouldn't be to hurt firms, it should be working with firms, say with fossil fuel firms. How can we improve and enhance? So even a BP can really do more safer production, less methane, and things of that nature. So it's very practical. So I think that's a big plus. And, the monies the Biden administration are putting in and agreed on infrastructure, lots of green stuff. So I think
again, Colin, absolutely. And when we think about the banks as technically, in many cases, holding a degree of the purse strings for these organizations, if we're looking at how they're allocating funds and how they're lending for environmental, which we've talked about, social, which is so important and is now coming to the fore, I'm seeing more. We've all been worried, obviously, about the environmental concerns, but you rightly talk about the social and the G. Hopefully, the banks can be positive enablers of change for us.
Yeah. And you got to say, you see, the issue is that, of course, people should just do so because they believe it's important. The public service or the protection of our planet should be something they take on board, but they don't. And that's why you need the government who provides the public good to penalize those that don't do it. So, for example, for banks, when we get onto capital requirements, banks that don't have a climate strategy where they are seen to be reducing over time, CO2 emissions and cleaning up the environment, where their monies go in to do otherwise, they will get penalized with capital charges. So it pays them to do that. I spoke to a rating agency recently and I said, well, let's say banks don't do this. They said, well, we don't really care from a current risk perspective that much for a particular bank we were discussing. But he said, if we found, okay, that this is like Moody's, when he worked for Moody's, he said that if we found that a bank did not have a climate strategy, okay, or an ESG strategy, we would immediately downgrade them. So it's now becoming a common purpose for all firms, small as well. But, I realize the regulation only kicks in from a certain level of activity for non-financial firms. But I think they should still do it. I think it's right risk-reward management because they will learn how to be more green over a long period of time. And I'm not saying, bet the whole thing on the green revolution, but I'm saying take a viewpoint, understand it's complex. In my consulting, I work with this company, Centigo. We have a battle plan, how to take an institution, any institution, and how to move it into, the late 21st century. If you don't do
that was something I actually wanted to ask you, which is a naughty extra question, so I apologize. Yeah. But I wanted to ask you, obviously, we've got these lessons that we've learned in the financial industry, and you have a strong heritage in financial industry. It is my belief, and I'm probably wrong, but it is my belief that all of these lessons that we've learned in the financial industry can be transported into the corporate world and help them evolve their practices and help them to jumpstart from where they are to the future and make themselves more commercial and so on and so forth from a risk perspective, whether that's environmental and societal governance, whether it's from stress testing, whether it's from treasury.
Yeah, I agree. I think absolutely. We could even think of public institutions having very strong risk management, having proper governance. They ought to, and you can apply the same principles. I think, when you asked me would I come on your program, I said, well, I'll talk about non-financial risks because non-financial risks, okay, I know you spoke a little bit now about treasury, but a lot of enterprise risk, including climate, including, say, adaptation of artificial intelligence, including, innovation, how to be commercially viable in those markets. And all the principles that we've used in banking can be applied. Not all, but it's got to be proportionate and pro rata to what you're doing. I had a friend who runs a big hardware company, and I said to him, well, what are you doing about your, whether it was screwdrivers? I said, you're getting screwdrivers from China, and I remember he told me once that the screwdrivers smelled, because they used a poorer process. I said, why don't you, and then you sent it back, why don't you do something like that on climate? Why aren't you doing anything on climate? And this is what he answered me. He said, it sounds very nice, and you can afford to have the luxury of having values, which I agree with. But he said, if I were to actually get those business processes to be climate friendly, I'd be out of business. So that's a challenge over there, is how can you be competitive in producing a product that big companies produce? And of course, by the time we'd finished discussing this, I learned something about the anatomy of oligopoly powers. Oligopoly powers, say in the US, but other countries, in the EU and in the UK, the companies lobby not to get regulation for their industry. So a guy like this in a small and medium-sized business, he would only really move seriously to start, greenizing what he does, providing he's competitive. And, Bill Gates talks about the climate premium. And electric cars, suddenly become popular when there's a benefit, because you start working out what the cost is. I've got an electric car, and it's now cheaper, and we also get no congestion charges, and then it comes cost effective. But you cannot rely on the goodwill of mankind in general. They just don't want to do it because they're maximizing shareholder value rather than economic or social value added. That's where we are. We didn't try and change that, but where we are, unless we regulate the bigger firms, it means for banks, bigger capital requirements if they're not climate friendly, and in sectors for commercial enterprise, whether it's, what's happening in tech, such as Google being concentrated, I think that oligopolies have got to be regulated, and climate will be a component of that. If you don't do that, then the SMEs are not going to be compliant with climate. They can't afford to be, they'll be out of business.
No, it's really interesting. So industry hand in hand with government, and it's something, I don't know if you've seen this, in France next year, the French government has just announced an initiative for the lowest earning families, where people, I believe it's 7,000 kilometers a year for work. They are going to, hand in hand with the car manufacturers, you will be able to have an electric car, a brand new electric car, for €100 a month, to try and deal with some of the social disparity between the price of buying a brand new electric car to how much it saves a household. So interesting.
Yeah, they're very interesting. And those are the sort of policies, the government's got to do. In the UK, they've come out with some of these policies. However, they don't have money anymore. We bankrupt, not really literally bankrupt. We're a lot poorer, post-Brexit, COVID. The government just don't have money to pump money into these schemes. And that's quite sad, but that's where we are today.
Yeah, I think the whole topic of Brexit, perhaps, if I can steal you for another day, would be a very interesting one.
Yeah,
well, any closing thoughts you have for us today and our fellow listeners?
Yeah, I'd just say that the idea of libertarianism, which I once subscribed to, that you've got all these private enterprises and capitalism is good. I think that this is a fallacy, because we don't know, well, now we do know what it impacts. So what happens to things like inequality? The greater is inequality, the higher is the probability of, populism. And then we get bad actors coming into power throughout Europe and in the US and here in the UK. So actually, these are what we call externalities. Every economic student studies them, that the private market can only solve certain things, but it can't solve some of the values that we stand for in the society, to be good citizens, to save the planet, to make sure that compensation's more equal, and so on. If you look at CEOs today, they paid 1,000 times the median wages, whereas in the 1950s, it was 3 or 4 times, and then it went to 50 times, and then it went to 100, but it's now at 1,000. So this is a society that's imbalanced, and I believe that leads to fascism in the end, because the people are going to basically say, we're not happy, and a politician will come and say, you know what, I feel for you guys, you're not earning well, you tax very highly, I'm going to save you. And the next thing is populist movements. Populist movements lead to geopolitical movements of population and so on, and we land up in a bad situation with regards to society. And this will be worsened with climate disasters. So those are sort of challenges outside the private market.
So the fact that perhaps the social contract is to a degree broken, where you work hard and you earn money and you can afford to live. This is a big concern.
Yeah, it's a very big concern.
Thank you very much, Colin. It's been an absolute pleasure and delight.
You've been watching How to Manage Risk with Emma Hawkins-Hale and special guest today, Dr. Colin Lawrence. See you next time.